But I just signed the largest trade deal in history. I think maybe the largest deal in history with Japan.
Hello everyone and welcome to Nomura's Week Ahead. I'm Dominic Bunning, head of G10 FX Strategy here in London. Today is Friday, the 25th of July. So we just heard there from President Trump talking up the recently announced US-Japan trade deal, one of a number of deals that's been announced in the last week or so. We've also had some media speculation that other negotiations have been going pretty well, for example, with the European Union. And financial markets seem to be taking this news in a pretty positive manner. Equity markets continue to edge higher, bond yields remain fairly range-bound, and overall volatility seems to be calming down going into the summer. That said, one bond market that stood out in the last few days is Germany, where yields have jumped quite significantly following some pretty hawkish ECB commentary after their July rate meeting. We'll discuss that and the potential EU-US trade deal shortly with George Buckley, our chief UK and European economist. We'll also have David Seif, our chief economist for developed markets, joining us to talk about the US implications of various trade deals, as well as to preview the FOMC decision and US labour market data, both of which are due next week. In Asia, Aradeep Nandi joins us to focus on trade developments in India and ASEAN, while we're also going to review the Japan upper house election, the US-Japan trade deal, and preview the BOJ meeting with my colleague from FX Strategy, Yusuke Mieri. So it's quite a lot to cover, and with no further ado, let's get stuck in.
We worked on it long and hard, and it's a great deal for everybody. I always say it has to be great for everybody. It's a great deal.
Well, all the noise this week has really been around the US, as it quite often is at the moment, given the current administration. We've got David Seif here, our chief economist for developed markets. David, there's been a lot of trade deals sort of being announced in various forms with the US, Japan, some other countries. As things stand, how do those trade deals kind of impact your thinking on US growth and inflation?
Hey, Dom. Well, great to be back as always. By and large, the trade deals that have been struck have been coming in at a higher rate than we had expected. So our baseline going back several months was that a number of trade deals would be concluded, but that they would largely retain a 10% reciprocal tariff rate. And clearly that has come in higher than that. So as a result, earlier this week, we actually increased our expectation for the average effective tariff rate that would eventually the U.S. would settle at. We're now at 19.5%, up from 15.2%, so a 4.3 percentage point increase. And that's largely on the back of both the fact that the deals are coming in higher than expected and our expectation that there will be fewer deals than expected. So, just thinking about growth and inflation, I think that overall this puts some downside risk to our growth forecast, which is already a pretty tepid 0.7% Q4 over Q4 and for GDP growth. Having core PCE in the very low threes by the end of the year on a year-over-year basis. I would say, though, that it's not such a huge change that we feel compelled to outright revise those forecasts in any significant way. If anything, we've seen data hold up decently well, not completely hold up, but hold up decently well, and then combined or offset somewhat with these even higher than expected tariffs. I think that the general story that we have had in mind really still very much holds. The Fed not being able to cut in September because of tariff-induced inflation and holding off until December with below-trend growth, a slowing labor market, but no recession, and certainly not a collapsing labor market.
Well, that leads us nicely to the Fed meeting on Wednesday next week. As you mentioned, in our view, no sense that they'll cut this meeting. That's very much priced by the market as well. Very little probability priced into the market for July. Given we're not really looking for any major changes in terms of the policy itself, what are we looking at in terms of the statement, in terms of Jerome Powell's comments. I mean, also he's been under a bit of pressure from Trump and various other people in the administration. How do you think that all plays out into the Fed's messaging over the next few months, and particularly on Wednesday?
Yeah, so we see Waller and Bowman, Governors Waller and Bowman, becoming increasing outliers on the Fed, and our expectation is that both of them will dissent on the dovish side of this meeting, calling for a 25 bip cut. I would say that that's reasonably high confidence when it comes to Waller. Bowman sort of shocked everybody by going from uber hawk to uber dove in one speech just about a month ago. She had said that she would support a cut in July if there were no signs of tariff-induced inflation. Now, we do think that we got those signs, but still, I think that the pretty remarkable shift that she made does make her more likely than not to dissent. However, ultimately that still leaves a most likely 10-2 vote in favor of holding rates constant, and most importantly, with the core of the committee firmly there, including Chair Powell. We don't expect the statement to change very much. There will be no SEP since it's a July meeting. I do think it'll be very interesting to see how Powell talks about what I would call nascent signs of tariff-induced inflation in the June CPI print, which came out last week. I do think there is a real possibility that if he emphasizes that we're starting to see what the Fed has said it expected, and also what we said we have expected, that could cause market pricing for a September cut to fall. So it is falling quite a bit. It's still in the just low 60s or 60%-ish range. So still seen by markets as arguably more likely than not. But I could easily see the possibility that he leans into that a little bit from a hawkish side and causes that to reprice. But alternatively, of course, he could just as easily say, well, we just got one print, sort of kicks the can down the road, where we'd have to wait until August CPI to really see, or the August print of July CPI to really see whether this is continuing to persist, this tariff-induced inflation. Certainly our view that it will continue to persist. And I think it's the Fed's view as well. But I think what's key here is what level of emphasis/confidence does Powell give in his press conference?
Yeah, it seems you guys are focusing a lot on inflation, which I think is very much fair enough given the tariff environment. But going back pretty much a year now, we had a bit of a shock in the jobs market. We've got payrolls data out next week. You mentioned earlier on most of the data seems to be holding up pretty well. You're pretty confident that's going to be the case in terms of this month's labor market release as well?
Yeah, well, we have I should just say that as of the time that we're recording this, we have not completely finalized our employment forecast. Although by the time this is published or published online, we will have finalized it, and our research will be out on that. But in broad strokes, we expect a small, a smaller than last month increase in non-farm payrolls, which was 147K, but only smaller by a bit. So still a pretty robust print, somewhere in the 130-ish type of range. We may have ended up revising that, as I said, a tiny bit between now and when we actually publish, but something in that range. And private payrolls, which were pretty anemic last month at just 74K, we see those being a bit stronger this month. So arguably, holistically speaking, that could come out to a better non-farm payrolls print, even if the headline number is a bit lower. Still, this would be, if it's in the sort of 130-ish type of range, that's certainly above what we think is break even in order to keep the unemployment rate steady in general. Now, we do actually see, that said, a slight increase in the unemployment rate. And that's because the unemployment rate does come from a different survey than non-farm payrolls and does not always move exactly in line on a month-to-month basis. So we think that that's more likely than not to tick up from the current 4.1% to 4.2%, although we do see a decent risk that it stays at 4.1%. All in, this would still be a pretty good NFP or employment report. The Fed has expected the unemployment rate to start rising more than this. This would be consistent with it actually being a little bit lower than the Fed has said it expects it to be eventually by the end of this year. And then more than that, it would be another month of a relatively robust NFP print.
Great, thanks, David. So all seems to still be kicking along quite nicely in the US. Deals being done, jobs still ticking over, and the Fed sticking to a relatively hawkish view. Let's see what happens next week. Thanks a lot.
My pleasure.
We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. We are not pre-committing to a particular rate path.
Well, moving on to Europe, we've got George Buckley, our chief Euro area and UK economist with us, and we're recording this in the aftermath of the ECB's July decision. We just heard a little comment there from Christine Lagarde talking about their data-dependent path, having left rates unchanged at 2%. George, the decision itself was pretty in line with expectations and somewhat unexciting, but there were definitely some comments in the statement and press conference which seemed to move the market. What did you make of the overall decision?
So yes, absolutely. Christine Lagarde was not dovish. She was, if anything, slightly hawkish, and talking about the fact that, or suggesting that we'd need something fairly significant now to get the ECB to cut interest rates. And, we've only got another 6 weeks or so until the next meeting, and it just seems like we're not going to reach that bar to get another cut. And so what we've done is we've taken both of the cuts that we did have for the ECB. We had one in September, we had one in December, out of the mix, because the ECB has said very clearly that it's looking at the very long term or the medium term to long term for its forecast for inflation. As long as they stay around about the 2% mark, they were slightly above 2% in their last June forecast. As long as they stay around there and data doesn't move that, then I think they're pretty comfortable with rates staying where they are.
I guess one of the big downside risks that the ECB flagged back in April was what was going on with trade. But this week, we've had some media reports, at least, that the US and EU might be close to doing a deal which would seem to have tariffs somewhere in the 15% sort of region. Does that have a big impact on your forecast? Does it change much from your perspective if that were to play out?
Yes, I think it does. A couple of points here is that we had been expecting 20% tariffs, so 15% would be less than that. And I think secondly, and more importantly, is that a deal is a deal. It means that you don't have the risk of or uncertainty surrounding trade policy anymore. And that could have a meaningful effect on economic growth because economic agents, whether they be households or in particular investors, and businesses, will feel a lot more comfortable in doing business. So I think that could have a material effect. It's also just worth bearing in mind that 15% is higher than what the ECB has penciled in its baseline effect. But of course, we could also see a reduction in tariffs on autos. It's very uncertain yet exactly what's going to happen, and of course it always is with Trump. But I think that if this goes ahead, and we have changed our view to assume 15% tariffs from 20%, and that's part of the package of our new ECB view of no change.
Okay, so somewhere in between what we've been expecting, what the ECB had been expecting, but ultimately something that feeds into the idea that the ECB could well be done and dusted with rate cuts. I guess the other part of this is obviously inflation, as you touched upon. We do have inflation data for July coming out at the back end of next week. What are we expecting to see there?
So we've got a couple of things next week. We've got GDP and the inflation prints. On the inflation prints, we think it's going to hover very close to the 2% mark. I think that the key thing that we're saying here is that the momentum in price growth continues to slow in terms of domestically generated services inflation. So the momentum behind that is slowing. And that's obviously good news. But as long as it stays around the 2% mark, I think the ECB is going to be comfortable with rates where they are. We've also got GDP as well. We're forecasting 0.1% Q on Q. That's obviously not that strong, a lot weaker because of payback from what happened in Q1 when some activity was brought forward into the quarter ahead of the tariff announcements. But we do think that growth is going to start to pick up. And when you've got growth picking up and inflation at target, that's exactly why the ECB, we think, will stay at where they are now, which is around about the neutral level at 2%.
Great. Thanks very much, George. All very clear. Have a great week ahead.
Thanks, Dom.
We're going to move on to Asia now. We've got Aradeep Nandi joining us from our Indian economics team. Aradeep, thanks for coming on. We've spoken about trade deals a lot already in the podcast, but Asia and ASEAN in particular has certainly not been out of the loop on this front. We've seen trade deals announced with the Philippines, Indonesia, Vietnam over the last few weeks. Quite broadly, how are we thinking about these deals, what they mean for these economies, but also what are the read across for the rest of the region? Can we see more deals being done? Is it going to be quite challenging for growth? How are you guys thinking about it?
So I think from the US perspective, there are essentially three things that's up there. One is, of course, better market access in these economies. The second point is reduction of the trade deficit, which the US runs with these countries, which essentially then means that getting these countries to purchase more of US goods. And the third one is the vexing issue of transshipment from China. So essentially, Chinese exporters evading US tariffs by rerouting their exports through Asian economies. Now, the deals that have been announced so far seem to hinge on these three aspects. We've seen this in the case of Vietnam, which is at the tariff is at 20%. So this is lower than the Liberation Day tariff of 46%. For Indonesia, it's 19% versus Liberation Day tariff of 32%. But in the case of Indonesia, it is higher than what our ASEAN team was expecting at 17%. And we don't know much about what's going on exactly with Vietnam, but we have some more details on the agreement with Indonesia. And what comes out is that Indonesia has agreed to reduce non-tariff barriers, be more accepting of US standards when it comes to exports, some kind of agreement on rules of origin, and purchase of US aircrafts, US agri-goods, US energy products, and then, of course, to avoid transshipment from China. In the case of Vietnam, it's 40%. In the case of Indonesia, it's the tariff from the source country plus 19%. So these seem to be like the common themes that are emerging in these trade negotiations.
Okay, that's really interesting. Thank you for the detail. It's quite notable to me that India seemed to be almost at the front of the queue when this all started off, but nothing's been announced there. Do you guys think there's much of a chance of a US-India trade deal being reached anytime soon? And if it is, what does it hinge on?
I mean, Dominic, we've spent the last 1 month getting news flashes saying that, a trade deal is going to be announced at 10 p.m. tonight. And, it's been going on like that for quite some time. So you're absolutely right. In fact, India started negotiating with the US before the Liberation Day tariffs. So India was really, really early in the game, and probably, that could be a reason also of the delay, in the sense that it could very well be the case that the bilateral trade agreement, or the BTA that's being discussed between India and the US, is possibly more detailed, because there is a lot of discussion that's happened so far. So look, India and the US teams have met for 5 times. In fact, the latest one was between July 14 to 17, where the India team went to Washington. And there is news that that the US team in August will be visiting India. There seems to be just from the again, there's little in terms of official announcement. So this is more of a sort of news leaks that one hears from in the media, which is that there seem to be disagreements, especially around what is India's red lines, which is agriculture and dairy products. New Delhi has so far resisted giving any duty concessions in these core areas, and in the case of what it seeks from the US, it is seeking the relaxation of the 26% tariff. It is seeking the easing of tariffs on steel and aluminium, and on the auto sector, so the sector specific tariffs also. And it's seeking duty concessions for labor intensive sectors like textiles, gems and jewelry, leather goods, garments, plastics, etc. And in fact, I mean, yesterday Prime Minister Modi signed the India-UK trade deal, and again, market access for labor intensive manufacturing seems to be an important part even of that deal. So this is what India is looking for, but I think the red lines that India has on agri and dairy products seem to be a matter of contention. We've been hearing reports that exporters are kind of readying themselves for 1st August because there's a lot of uncertainty on what kind of tariffs will exist beyond then. Will it be an extension of the base level tariffs, or will there be a escalation of tariffs? There is little clarity on that. But yeah, I mean, there seems to be still some ground left for the two countries to cover before they sign the deal.
Okay, we'll have to just watch that space pretty closely, I guess. Thanks very much, Adeep. Have a great week ahead.
Yeah, thanks a lot.
We're going to finish this week talking about Japan, where it's been a very busy week or so. We had the upper house elections over the weekend, last weekend. We've had some interesting news on trade, and we've got the BOJ meeting next week. So Yusuke Miyari is joining me this week, my colleague from FX Strategy. Yusuke, thank you for coming on. Let's start with the election. Just simply, what actually happened at the upper house election? Was it in line with expectations? And what do you think it means from a political perspective in Japan going forward?
Hi, Don. Yeah, so the Japanese 2025 upper house election concluded with the ruling coalition securing 47 seats. We think this performance appears to have been better than what the market was positioned for based on the pre-election polls. But what we think is important is that, even with this result, the probability of Prime Minister Ishiba resigning has certainly increased since the election, as per media outlet reports. So whether he resigns or not, then if he does, then I think there will be another political uncertainty kicking in. So I think that's what the market's next focus on.
Okay, interesting. He obviously had a bit of a coup the week after when he announced, or Donald Trump announced, a trade deal with Japan. Do you think that trade deal is kind of particularly meaningful for the economy? Is it going to really change the way in which people think about growth or inflation, or is it more of a symbolic gesture at this point?
Yes, yeah, so I would say that 50% tariffs on universal items and autos came in as a genuine surprise, especially on the autos. And we think this deal is likely to improve the business outlook for Japanese companies. Obviously, depending on trade deals for other countries, Japan may not necessarily have a strong relative advantage. However, this development remains positive for global economic growth and consequently positive for the BOJ outlook. So overall speaking, we got the tariff reduction from 25% to 50% for reciprocal and 50% auto will likely be positive, have a positive influence on the yen and also on the Japanese economy.
And you mentioned the BOJ there, which obviously this week we've got the meeting coming up. I guess it's too early for this to really shift the needle for the BOJ, but how do you think policy could evolve both this week and also looking a bit further ahead?
Yeah, for the upcoming meeting, we're not expecting any change on the BOJ's monetary policy. So the uncertainty on the tariff rate itself has decreased. However, we don't know, we and the BOJ need more time to assess how much tariff would impact on the Japanese economy. So given that uncertainty, especially the second part, we think the BOJ will stay on hold for this time's meeting. However, I think the likelihood of an October hike has risen thanks to this trade deal. We had Deputy Governor Uchida saying that the latest trade deal has reduced uncertainty over the tariff negotiation, and as a result, in theory, has increased the likelihood of meeting the BOJ's economy inflation projections. So overall speaking, in the near term, the BOJ is unlikely to change its monetary policy stance, but we still have 3 more months until the October meeting, and by then, I think the door is open for the BOJ to consider a hike in October.
Great, thanks very much, CZK. So lots to think about, but certainly a few factors there that should be fairly positive for the yen from the FX side. Thanks for joining us.
Thank you, Dom.
Well, that seems a good place to end it for this week. Thank you for listening in to this week's edition of The Week Ahead, which was edited and produced, as always, by John Dalton. If you're enjoying the show, please like and subscribe to Nomura's podcast on Apple, Spotify, SoundCloud, or wherever it is you get your weekly podcast fix. We'd love to hear your feedback, so please do write a review and share this podcast with your friends, family, colleagues, and anyone else you think might be interested.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.